transition to our first slide, as an overview, what I really want to make sure to communicate to folks is a high level of why this is important and the kind of the key drivers when you're thinking of wealth transfer, and also in the timeline of when it's important to implement different pieces. So to start, I believe there's really four key documents for business owners. And this in particular, I would say three key for everyone. Four, I think trusts are really important and key for business owners. But if you don't have this in place, make sure to get them in place because this is appropriate day one, early development. You got to make sure to get these in place because they're very important for you and your family. But we want to make sure to not stop at the basic documents. And let's say, fast forward a little bit as we go to the next slide, we're moving more to the mid stage. So, mid stage and later, you have a really great opportunity. If you don't mind clicking one slide forward. There we go. Okay, so this is a little bit of animation. I promise I limited it, but I want to make sure to graphically illustrate what we're dealing with because I feel like sometimes advisors and business owners let the tax tail wag the dog. And so when we're looking at wealth transfer, vision this as just really your total wealth. And then if you just click like basically once or twice more, when you go through your plan and establish really what's your core wealth, the amount that you need to have that where you're good, that funds is not what we're talking about fundamentally with the transfer techniques I'm going to bring up. I'm talking about more what we can do to leverage that excess to minimize wealth transfer taxes and maximize the benefit to, and if you click one more time, really, obviously, family, friends, charity, it's really whoever you want to give the excess to. And it also could be potentially spending on things that aren't part of your core plan or extra trips or potentially even starting a side business or something of the sort. It's really how to deal with the excess in a tax efficient manner. And if click next one. So one difficulty with any of the talks that I have on these is we get to deal with two very fun things, death and taxes. So it can come across as a little bit dry, which I completely understand. And please forgive me if this glosses over a little bit, but I tried to keep it high level to show you how important it is. So when your team of business advisors, and I say business because it's important, these tools are oftentimes available to everyone, but they make an enormous leverage difference with business owners. So when you're looking at it, the advisors are primarily trying to avoid the items on the left that are transfer taxes. Typically, the top rate on those is 40%, which just do some simple math. You have an exposure in the state tax of 10 million. That's $4 million. So we're not talking about just a cheap lunch, so to speak. And it's important to understand why you should make sure to examine these techniques because they have various levels of complexity and implementation that it will require your attorney, your wealth advisor, your CPA. It really does require proper coordination to work well because your team is effectively trying to use two limited pooled resources. And that is the exemptions as they currently stand, which is the annual exemption. This is for gift and estate tax and GST tax of $15,000 each. You're probably already familiar with that. You may already be taking advantage of it. It's one of the pools of limited resource that you can use to leverage giving money to really anyone. The other one is your lifetime exemption. This is as you could probably tell, lifetime. It's cumulative over and above that 15,000 individual beneficiaries. And to give some perspective, we're in an incredibly favorable estate planning environment. Roll it back to 2003, there was only a $1 million lifetime as well as gift tax exemption per individual. Right now, it's $11.7 million for you and if you're married to your spouse. So I mentioned it to say is we are in one of the potentially arguably the best environments in history between the exemption standpoint and also as far as interest rates and such from that sort of standpoint. And it's really important to look at it because if you can take advantage of some of these techniques I'm talking about in the mid stage, you can hit that progressive growth of the business to avoid an enormous amount of taxes and leverage what your excess is to benefit those you want to benefit. So I'll just click over the next slide. So what I want to do is show a few high level techniques. And as Mike mentioned in the chat, we're going to be going into additional depth on these techniques because the devil's in the details with all of these. I want to show you how generally you use some of them, but they're very much things that you need to have implemented correctly and don't make sense for everyone. These ones, if you notice, you probably recognize a few of the acronyms. You may have seen your advisors talk about them. I want to just mention why they're useful as an example of techniques you can use, because there's others available. There's the alphabet soup of trust setups that, depending on your circumstance, either make sense or will possibly cause you to just lose your lunch in the complexity of it. But it's important to really understand high level what the point of it is. And so, to mention as an example, part of it can be so incredibly powerful is if you think back to 2008, pre-IPO for Facebook, the co-founders actually made use of this first technique, the GRAT, and I'll talk about it in just a minute, to effectively pass an estimated of $185 million of value in Facebook through the GRAT structure, which avoided the gift tax and estate tax. That's a lot of money saved. And it's incredibly important to implement these well because in the right fact pattern, especially with business owners, they can be enormously powerful. I keep on mentioning the right fact pattern because all these strategies, when you think about what to implement, they have a cost. They have a cost in time. They have a cost in money, of course. They have an opportunity cost for what you're going to do with the funds. And they also just have a level of complexity. I mean, some clients and some folks just, they like to keep things as simple as possible. So it's important to find the right level of complexities for you and your advisors so you can implement it to save a ton of money. But also, it's this, one of my favorite metaphors is to say the difference between a Camry and a Ferrari. The Ferrari is a lot more expensive, breaks down a lot smoother, but if all you need to get is from point A to point B, then a Camry is probably a better decision. So these four examples you see is the grantor retained annuity trust, the intentionally defective grantor trust, and then family limited partnerships and this SLAT. I mention these just because those are some ones you'll likely see without kind of spending too much depth. And so go to the next slide. We'll trying to keep things moving at a good pace to we can keep you on schedule. So with a grantor retained annuity trust, let me show you as an example. What you're doing is you form a trust as per the name. Let's say you contribute $1 million into the trust, and then the trust effectively guarantees to pay you back an annuity stream of payments equal to your original contribution plus what's called the 75/20 rate. So the question is like, well, what's the point in doing it? One is this is typically called a zeroed out GRAP, and then you goes for a period of term of years. Fast forward for this 2-year GRAT, let's say at a 30% growth rate with you could potentially even contribute your business interest, you put it in there, it would be worth 1.69 million approximately. At the end of the term, then your remainder beneficiaries trust would get the assets over and above that annuity payment. In my example, $690,000. Of course, this is the example. All you have to do is add zeros the more you use this strategy to see the leverage you can take for it. But the point is that 690,000 avoided gift tax and estate tax and has a pretty short time horizon so you can roll these. There's other intricacies as well, but it's a great way of avoiding the estate tax and gift tax and allow you to leverage your excess to make sure more goes to who you want to and less goes to Uncle Sam. Because I absolutely believe that I've yet to encounter a single person who complains when Uncle Sam gets less. So if you are concerned by that, let me know. We can definitely talk. I'd be curious to have a conversation. But the GRAT's an incredibly useful one. It's also been used by the Walton family with Walmart. It is one of the most common ones you'll see. So jump over to the intentionally defective. There we go. So here's an example of where the first one doesn't use any lifetime exemption. Here's an example of another strategy that allows a business owner to contribute potentially ownership in your company to leverage your lifetime exemption. So in this example, you give $1 million and it could be business ownership. In this example, that's what I was envisioning. You put into the trust, you can set up trust terms flexible to what you want, and then have a course of years. I assumed a very conservative 7% growth rate. But the point is, The value of the growth and everything from the moment you gift in that trust is exempt from your estate tax and gift tax. So, my example, you put in a million, it grows to 7.612. All that growth is 6.612 million, avoids 40% in estate tax, millions of dollars. And I like Mike mentioned to say approximately 6 million transaction tasks. It's really important to be able to do this right, because you can, what I like to tell people is let us know what end outcome you want it to be, as in who you want to give money to and who you want to benefit. We can help you get the best impact and to get to that place. There's sometimes complexities along the way, but let us know where you want to get, and your team advisors can make sure you get there well. So I'm going to move actually on to a little bit on the charitable side. And the reason I wanted to mention the charitable items last is, in a lot of ways, the charitable items are things where you can have a great impact and great tax benefit, but you're not going to be better off giving money to charity. And tongue-in-cheek joke is, if you give money away and you made money from the transaction, then the IRS probably wants to know about it. So while it's wonderful to save taxes using charitable giving, you first want to make sure that you want to give charitably. And that's not a right or wrong decision. It's simply a matter of subjective what you want to do. And so if you have that charitable intent, there's ways you can do it in a very advantageous way. And so these three you mentioned, donor advised fund, private foundation, charitable trusts, are one of the ones we see most often used. Very flexible, depending on your circumstance, you utilize a combination, one or potentially two of these to get to a good outcome. But ultimately, you got to start with whether you want to give money away. So I'm going to dive in a little bit into the donor advised fund portion of it. And this is an example of a simple technique that we use all the time with business owner clients, but is also available to anyone. Because a donor advised fund is fundamentally think of it like a brokerage account with a charitable wrapper. And you advise that brokerage account for where you ultimately give after then. So in this case, it's a perfect example of a great benefit for anyone that anyone could use. But if a business owner uses it, it has a double impact. So let me graphically explain this. On the top, you basically see you give $1 million to charity, and you get $1 million charitable deduction in the year that you give to the charity. Straightforward. Let's say your marginal rate's 45%. You save $450,000. Wonderful. That's great. But here's a great opportunity for business owners. If you click, I think I have 2 more clicks in there. If you instead, let's say that you gave your portion of your business ownership that you actually pay, your basis in it is only about 100,000. You could give that, which the market value is mine. Now, my example is $1 million, so you get the same income tax deduction, but in this example, you didn't sell it. So you didn't sell, generate cash, give that to charity. You gave it to this donor advised fund as a charity. You get that market value deduction, and you avoid realizing capital gains. Just as a mention, Nathan Corbett is an expert in this charitable giving strategies. It also allows you to avoid things like depreciation recapture. That's a way more detail we're going to go into in this overview kind of slide, but there's ways you can leverage it. To my example over there, you still save the 450 in my example, but then you also avoid paying more tax on top of it, so that your $1 million gift would potentially save you about $684,000 in taxes, which is huge. Goes back to, you're still net off, you're still negative because you gave money away, but your impact was multiplied on the charitable side. So at the end of the day, though, I want to make sure to mention before we kind of go to questions is, whenever you're passing along, always try to focus on, this is why I like charitable giving. You want to make sure to always focus on passing along your values and not just your assets. It's the classic phrase of, is your money safe with your kids, and is your kids safe with your money? When we're talking about this in more depth in a webinar that we'll send out, but also there's a session 6 is when Nathan is doing the giving away funds. You got to make sure to also pass along the values and what you believe, and not just the assets in an efficient way. So at that stage, it looks like we're right on the mark for noon from our time. So I'm going to take a pause and to see if you have any questions for myself or Annika, and we'll go from here.